Yeah, you might think in this scenario, US Treasuries and bonds should be the safe haven. Well, right now, as we stated before, there is a run to liquidity. And what do people sell in those moments to raise liquidity? It's cash equivalent things. US Treasuries is essentially, especially the shorter term ones, are essentially exchangeable one to one for cash. They're being sold off in the interim to get hold of cash. Sovereign nations need higher levels of cash on their balance sheet to now, if they're a net importer of oil or if they just need to stock up their supplies, they need to reach out and now pay premiums to get oil into their country. So they're needing to raise fresh liquidity. There's a bit of that going on, and there's also that longer end of the bond yield, which is the 10-year, the 20-year, and 30-year, which directly affects the mortgages and interest rate on debt. That's alarming for the government. They have to look at that soon if they continue to go higher. But similar ideas and thoughts around that. Japan holds a lot of them. Some other sovereign central banks around the world hold the debt on their balance sheet. They're likely going to be selling that off. It cannot print new oil, rather. What they are now grappling with is that inflationary inflation shock, where the impulse would be to do what they've done in the last couple of years, and that's raise interest rates, tighten the cost of capital, protect their currencies, protect their bond yields. But because they can't print energy, this is a consumer inflationary moment where if things do play out over the next 6 to 12 months, and I'll show you the data which I'm looking at, which details how much fuel we actually have left and all the projections based on all the different scenarios, there likely will be rationing, uh, restrictions on travel, sparser shelves, stimulus to hold things together and hold that middle class together from paying their mortgages and just buying food. And also there might be things like being able to access your super again. So think COVID, think of a lot of the second and third order effects from COVID economically. What happened then? What would happen now if travel was restricted? Similar dynamics. Obviously, there's no pandemic, but it's similar. Have our bids. Let's be safe in some liquidity. I don't think an allocation any greater than 50% is prudent for most people. Again, I'm pretty highly allocated in the market. That's fine for me. Do what you feel is prudent, but I think having currency, liquidity, dollars available for that nuke that we're all hoping for is so prudent. Until we get that weekly close above 74, I don't think we have to do a thing. We just have to sit here, monitor the DXY, Bitcoin, S&P 500, and see what the hell is going on. And if we see really big shocks to the downside, I think that is going to be the time to obviously buy. And then we just sit. We don't do a thing. We wait for things to respond. It's never all at one go either. We have bids. We maybe have some capital sitting outside of bids, waiting for that moment. Okay, we've got a level that we just did not think would come. It might be 40,000, it could be 30,000 in a big movement down a wick, and then suddenly it's back up to 40 or 50 or 60. That's the area we want to be throwing in a lot of money if we've got it still available. So, guys, hope you have a wonderful day. And as always, just stay positive.